Hi, welcome back to John Smith 02. If you have been watching the silver market over the past few weeks, you already know how rough it felt. Prices dropped hard, headlines turned negative, and a lot of investors who were excited about silver just a month ago started to wonder if the whole rally was already over. But something interesting has been happening over the last several trading sessions, something that is easy to miss if you are only looking at the daily price swings and not at the bigger picture underneath them. Today we are going to slow down and walk through three separate signals that, when you put them together, tell a very different story than the panic headlines suggest. None of these signals alone would be enough to change anyone's mind. But when three unrelated forces start pointing in the same direction at the same time, that is usually worth paying close attention to, and that is exactly what is happening right now with silver. Let's start with why this moment matters in the first place. Silver has always been a strange metal to follow because it lives a double life. Part of it behaves like a monetary asset, something people turn to when they are worried about inflation, currency weakness, or instability in the broader financial system. The other part behaves like an industrial commodity, tied directly to factories, solar panel production, electronics, and the ongoing build-out of electric vehicles and data centers. When both of those forces are healthy at the same time, silver tends to get a lot of attention very quickly, because you have investment demand and industrial demand pulling from the same limited pool of physical supply. That is roughly the setup we have been sitting in for much of 2026, and it is part of why the recent drop felt so jarring to people who had been following the metal closely. A pullback after a strong run is normal. What matters now is what happens next, and that is where these three catalysts come in. The first catalyst is the cooling of fear around aggressive Federal Reserve rate hikes. Now, this is important because interest rates and precious metals have a very direct relationship that is worth understanding clearly. Silver, like gold, does not pay you any interest or dividend just for holding it. So when interest rates are high, or when the market expects them to keep climbing, investors can earn a safe, predictable return just by parking money in bonds or savings accounts instead. That makes silver less attractive by comparison, because you are giving up that guaranteed return to hold a metal that only pays off if the price goes up. But when the market starts to believe that the Fed is done hiking, or is even getting closer to cutting rates down the road, that calculation flips. Suddenly, holding an asset like silver does not feel like such a sacrifice anymore, because the alternative of parking cash somewhere safe is not as rewarding as it used to be. Over the past few weeks, incoming economic data and recent commentary from Fed officials have shifted the tone. The aggressive rate hike fears that were driving a lot of the recent selling have started to soften, and traders who track interest rate expectations closely have noticed the shift in probability pricing for future Fed meetings. This does not mean rates are about to drop overnight. It simply means the extreme worst-case scenario that had been pressuring silver seems to be losing some of its grip, and markets often move just as much on changing expectations as they do on the actual policy decisions themselves. Think about it this way. Imagine you are deciding between two jobs. One pays a fixed, guaranteed salary with no upside. The other pays less guaranteed money, but has real potential for bonuses if the company performs well. If you are convinced the guaranteed salary job is about to get even better, you take that one every time. But the moment you sense that guaranteed offer is no longer improving, and might even shrink a little, the job with upside potential suddenly looks a lot more interesting. That is basically what has been happening in the minds of large investors when it comes to bonds versus precious metals. As the guaranteed side of the equation cools off, the appeal of an asset like silver, which has real upside if inflation stays sticky or the dollar weakens further, starts to grow again. The second catalyst is something a lot of casual observers overlooked completely, and that is the price resilience silver has shown above the $60 level. Here's what this means in practical terms. After a sharp decline, the most important question is not how far did the price fall, but where did the selling actually stop. When a market drops and then finds a floor at a specific price level, and holds that floor even when there is negative news circulating, that tells you something meaningful about who is left in the market and what they are willing to do. Over the past couple of weeks, silver has tested the $60 area multiple times, and each time, buyers stepped back in before it could break down further. This is not the same as saying the bottom is guaranteed to be in forever, because markets can always surprise you. But repeated tests of a price level without a breakdown usually signals that there is real buying interest at that zone, not just speculative traders trying to catch a falling knife. Long-term holders and larger institutional buyers often use exactly this kind of price behavior to build or add to positions, because a level that has been tested and defended multiple times becomes a reference point the market respects. Let's break this down a little further using a simple comparison. Picture a tug-of-war between two teams, sellers on one side and buyers on the other. During a sharp sell-off, the sellers are clearly winning, and the rope keeps moving in their direction. But if the rope suddenly stops moving at a certain point, even though the sellers are still pulling hard, that tells you the buyers have planted their feet and are holding their ground. The fact that silver has not broken meaningfully below $60, despite waves of nervous selling and negative headlines, suggests the buyers in this tug-of-war are stronger than they appeared during the initial panic. Price action like this often gets overlooked because it is quiet. It does not make for dramatic headlines the way a sharp drop does. But for people who study markets closely, this kind of stubborn resilience at a key level is often more meaningful than a single day of big gains. Now here is a natural moment to pause for a second. If you are finding this kind of breakdown useful, going through market signals in a clear and grounded way without the noise and without the hype, it really helps the channel when you hit that like button, and if you have not already subscribed, consider joining the community here on John Smith 02. It costs nothing, and it helps this kind of content reach more people who are trying to understand markets without getting overwhelmed. Now let's get into the third catalyst, which might be the most interesting piece of this whole puzzle. The third catalyst is the visible pattern of accumulation by what people commonly call smart money, which generally refers to institutional investors, large funds, and other well-capitalized market participants who tend to have more resources, more research capability, and often a longer time horizon than the average retail trader. Now this is important because smart money does not typically chase headlines the way retail sentiment often does. When retail investors are panicking and selling into weakness, large institutional players are frequently doing the opposite, quietly building positions while prices are depressed and while public sentiment is negative. Over recent weeks, data tracking flows into silver-backed exchange-traded funds, along with COMEX futures positioning reports, has shown a pattern consistent with accumulation rather than distribution. In simple terms, more silver-related contracts and fund shares are being bought and held rather than sold and closed out, even as the spot price experienced its recent volatility. This kind of behavior does not guarantee a specific outcome, and it is important to be careful here, because institutional positioning can shift, and no single data point should be treated as certainty. But historically, periods where large-scale accumulation happens during price weakness have often preceded stabilization or recovery phases, simply because these buyers are absorbing the supply that panic sellers are releasing into the market. Here's a simple way to think about this pattern. Imagine a busy marketplace where a rumor spreads that a particular good is about to become worthless. Most regular shoppers rush to sell whatever they are holding, worried about losing value. But a small group of experienced traders who have seen this pattern before and who have done deeper research into the actual supply and demand picture start quietly buying up everything the panicked sellers are letting go of at a discount. They are not making noise about it, they are simply accumulating, patiently, while the price is low. That is essentially the picture that recent positioning data paints for silver right now. It does not mean everyday investors should try to copy every move that large institutions make, because these players operate with different resources, different time horizons, and different risk tolerances. But it is a useful data point to be aware of, especially when it lines up with the other two catalysts we just talked about. So let's connect these three pieces into one simple mental framework you can carry with you. Think of it like a three-legged stool. The first leg is the interest rate environment, which affects how attractive silver looks compared to safer interest-paying alternatives. The second leg is price behavior at key levels, which tells you whether real buying interest exists at a given zone or whether the market is just drifting lower on thin trading. The third leg is positioning data, which shows you what large, well-resourced investors are actually doing with their capital, as opposed to what headlines or social media commentary might suggest they are doing. A stool with only one strong leg is unstable and can tip over easily. But when all three legs are present and reasonably solid at the same time, the structure becomes a lot more stable. That is roughly where silver sits today, not guaranteed, not risk-free, but supported by more than just one isolated piece of good news. It is worth being balanced here and acknowledging that markets rarely move in a straight line, and this situation is no exception. There are real risks and uncertainties still on the table. Economic data can surprise in either direction, and if inflation numbers come in hotter than expected, the Fed could still maintain a more aggressive stance longer than the market currently anticipates, which would remove that first catalyst almost entirely. Price levels that have held in the past can still break down if enough negative pressure builds up, especially if there is a broader risk-off event across financial markets that drags down commodities alongside stocks. And institutional positioning, while currently showing accumulation, can and does reverse, sometimes quickly, if the underlying assumptions driving that buying change. None of these three catalysts should be treated as a guarantee of what happens next. They are simply signals worth paying attention to, pieces of evidence that, together, paint a more constructive picture than the panic-driven headlines from a few weeks ago. Looking ahead, there are a few different ways this could play out over the coming months. In one scenario, the cooling rate hike fears continue to build. Inflation data stays elevated enough to keep real interest rates in check, and the combination of resilient pricing and continued accumulation leads to a steady, grinding recovery in silver, without the kind of sharp spike that grabs headlines, but also without another sharp leg down. In another scenario, the broader economy shows unexpected strength. The Fed signals a more hawkish path than currently expected, and silver spends more time consolidating in a range before any clear direction emerges, testing the patience of both bulls and bears. And in a more dramatic scenario, if industrial demand continues accelerating alongside investment demand, and if supply constraints that have been building for years become more visible to the broader market, you could see a more forceful move higher, similar to patterns we have discussed in previous videos on this channel. The honest answer is that nobody knows exactly which of these paths will unfold, and anyone claiming certainty about short-term price direction is not being fully honest with you. What we can do is track the evidence as it develops and adjust our understanding accordingly, rather than getting emotionally attached to any single outcome. For everyday investors watching this channel, the real value of understanding these three catalysts is not about trying to perfectly time a trade. It is about building a clearer mental model for how markets actually work underneath the surface noise. When you understand why interest rate expectations move metals prices, why price levels that hold repeated tests matter, and why tracking large-scale positioning can offer useful context, you become a more informed participant in your own financial decisions, whatever those decisions end up being. This kind of knowledge also helps you stay calmer during volatile periods, because you are not just reacting to scary headlines, you are able to place those headlines into a broader context and ask whether the underlying fundamentals actually support the fear or not. To bring this all together, the recent panic around silver's pullback made for dramatic headlines, but a closer look reveals three separate signals quietly telling a more balanced story. Cooling fears around aggressive Fed rate hikes are reducing the opportunity cost of holding a non-yielding asset like silver. Repeated resilience above the $60 level suggests real buying interest has planted its feet at that zone. And visible accumulation patterns among larger, well-resourced investors suggest that at least some sophisticated participants see current prices as an opportunity rather than a warning sign. None of this is a promise about where silver goes next, and this video is not financial advice, just an educational breakdown of market signals worth understanding. As always, do your own research, consider your own personal financial situation, and if needed, speak with a licensed financial advisor before making any investment decisions. If this video helped you see the silver market a little more clearly, consider subscribing to John Smith 02 for more grounded, no-hype breakdowns of what is actually happening in precious metals and the broader economy. Thanks for watching, and I will see you in the next one.